Good morning, everybody. Thank you for joining us today, and welcome to the ESX Rise and Shine breakfast called Trends in Mergers, Acquisitions, and Valuations, sponsored by Alarm Capital Alliance. My name is George DeMarco, ESX Chair, and I'll be your moderator today. I'm thrilled to be part of this program and share the stage with these industry thought leaders, mostly because I don't have too many thoughts today after the crawl. So at this time, please welcome to the stage, we have Amy Kottari, President and CEO of Alarm Capital Alliance, Mel Mahler, Chairman and CEO of ADS Security, Joe Nuccio, President and CEO of ASG Security, and Bill Polk, Managing Director for Capital One Financial in Security, Defense, and Technology. In business, many of us fly at different levels to analyze certain opportunities or strategies, whether it's at 50,000 feet, 30,000, or even 10,000 feet. It depends on where one's individual perspective and comfort level is. I encourage you today to think about it in a different way. Whatever level you normally operate at, change your viewpoint by turning the view upside down to get a broader view of the universe, the business universe that is. This perspective may help you seek new possibilities and opportunities for business now and in the future. So today our goal is we're going to continue focusing on gaining the business intelligence for electronic security professionals and system integrators. Our speakers will provide you their unique outlooks, sharing the opportunities as well as the challenges facing the industry as it relates to trends, acquisitions, and valuations in the security industry. So we're going to get started with opening remarks from Ms. Kottari, and then we're going to open it up to the other panelists for their perspectives, after which we will have a question and answer portion of the program. I have some prepared questions, but I really encourage you to ask the questions. We want to invite you guys to ask questions from the audience, and we'll have a roving mic. So first off, let's please welcome Amy Kottari for opening remarks. Thank you.
Good morning, everyone. Thank you for joining us this morning at the ESX Rise and Shine breakfast. We're going to be discussing, as George said, the trends that we're seeing in mergers, acquisitions, and valuations in our industry. Thank you, George, for pulling this together and for moderating today. And I also want to thank Joe Nuccio, Mel Mahler, and Bill Polk for joining our panel. We're truly thankful that you guys are here today. I know there'll be some terrific questions, and hopefully all of you will leave today with some added insight as to what's going on in the industry. But even after the panel's over, don't hesitate to ask any of us questions that you may have. So historically, new trends in this industry are very slow to catch on, and even longer to ultimately impact value. Until about 2 years ago, we saw very few changes in the industry for, say, the last 20 years. Valuations ebbed and flowed, but RMR was RMR. And if you wanted to grow your business, you had to add new customers. Over the last 2 years, the game has changed. Home security has become more about home automation. The emphasis is shifting from protection to connection. Customers want to be connected. They want to know what's going on, and they want to be able to control everything remotely. With these changes, we're seeing buyers and sellers are seeing new sources of revenue that are driving value, driving incremental RMR from existing customers, and creating new business opportunities. Along with the new sources of revenue, there are associated costs that need to be considered, hardware, software, technology platforms that need to be thought through, different types of panels, cellular, IP, 2G, 3G, 4G. It's a very different world than it was a few years ago. At times, it can all be very confusing. But as a result, the marketplace is more active than ever. Whether you're buying, selling, or merging, you want to focus on and understand these changes as they impact your P&L. Understanding these changes are critical. Everything, especially if you're considering a transaction, once you have a good understanding of how these changes are impacting your P&L or the company that you're considering buying, you want to think about timing. And timing is very interesting right now with respect to capital gains, access to capital, and as well as some of the larger transactions that have happened over the last 2 years. The capital gains rate will more than likely increase in 2013, regardless of who's elected in November. It's already part of the Bush tax cuts, which are expiring at midnight on December 31st. So if Obama's elected, it's 99% certain. If Romney wins, he's going to need some help from Congress. So in addition to these capital gains rates changing, at this time capital itself is cheaper, more accessible, with many more lenders entering the security space over the last year and creating many more opportunities. We still see some fairly stringent lending practices, particularly for mid and down market companies. But if you have quality accounts and a well-managed business with supporting metrics, the access is there. Also, the flurry of larger deals in the last 2 years confirms the industry's focus on size. But quality is still king, and all companies with a proven track record will be sought after over the coming years. The composition of RMR, the average RMR, and the associated costs may all be evolving, but the key metrics still remain the same. And for my company, they continue to drive our acquisition decisions and our due diligence process. The factors and metrics that directly impact the IRR of any deal are the cost of capital, attrition, and free cash flow, the latter two of which level the playing field between any two transactions. So whether you're thinking about buying or selling, it's critical to focus on a few things that drive success in this business: RMR growth, well-managed costs, and attrition. If you can get those three things right and pay attention to the latest technology, you are set up for success in a market that is truly ready to support success. So thank you for being here, and hopefully we'll be able to address some of these thoughts over with our panel. Thank you, George.
Thank you. Now I'd like to turn it over, and we'll start with Joe Nuccio on some of the comments that Amy made. If you can give us kind of a 1 or 2 minute.
I think Amy hit it right on the head. I mean, I think today we're in some pretty exciting times. With technology changing so much, I think it gives everybody an opportunity to really build some really nice size, high quality companies. I mean, the one thing that doesn't change is the service. I mean, that's what we're here for. We don't really manufacture products, we provide service, and I think the companies that continue to focus on their customers and provide service are going to have a lot of value.
Thank you. Bill.
I would agree. I think the important thing to recognize is that these new sources of revenue are getting better understood by the capital markets, both on the debt and the equity side. And as that becomes clearer and the values are more accurately defined, the capital will flow. The capital markets are not innovators. These aren't people, with the exception of a small niche of the market, the venture capital community. The capital markets follow, and as the values become established, the capital will flow into the businesses that prove out their models.
Thank you. Mel.
Amy said that she believes that the capital gains tax is going to go up next year. We really believe that as well. And we're seeing that fuel a lot of activity right now. In our 21 years, we've completed 130 acquisitions. And we've got 14 standalone locations in 5 states. But obviously, at 130 acquisitions, most of those were fold-ins. And we're sitting today with 3 letters of intent signed. Expect to have 2 of those to close in July. The other one is more problematic, so it might not, okay? But, and the big dilemma, unless the person is ready to buy the house on the beach or retire, the big question you face is, what do I do with the money when I get it? So what we try to do is, if they're not ready to really do that and get that less than 1% interest on a money market fund, then we try to establish a relationship, either third-party monitor with them, buy some of the accounts, and then eventually when they're ready to make that tough decision, do the complete acquisition.
Great. Hopefully we're going to have some opposing views at some point. They all agree with each other, but we'll see if we can throw some questions at them. I'm going to do the first one. We're going to start off. What are the determining factors that buyers or creditors look for when valuing my company? And how can I best prepare to sell my account or business? Joe, why don't you take that one first?
Well, I mean, I think one of the first keys is, as a seller, I mean, what's really important is on the reoccurring services, I mean, you need to have good, sound contracts that have all of the proper clauses in them, and I think that's probably the most important. I mean, the asset today, even from Bill's perspective and lenders, is still going to be that RMR and that contract. I think the other thing that you could do is really kind of make sure that you focus your business on what you do as a core and not really stray away from that core. And if you're in a specific geographics, you want to really strengthen that geographics, not necessarily expand so far out that you can't control, the servicing of your customers. I think that's probably some of the most important things that...
Mel, do you have some comments on that too from your perspective?
Well, Joe talks about concentration, and we're strictly in the Southeast. And we have opportunities that come up in, north of the Mason-Dixon line. And of course, my wife's in Mississippi. She said, if we ever do anything up there, she's leaving me. So, and the Southeast is not only that concentration, but it's the high growth area in the United States. If you look at Forbes' forecast for the next 10 years, which metropolitan areas are going to have the fastest growth? You're in number 3. They're predicting the Nashville metro market to be the 3rd fastest growing area. And, we're just seeing, we've had record sales now every month since August up until present.
So now from the perspective of you and Bill, what kind of counsel would you give an alarm company owner?
Who's looking to sell?
Yes.
Everything that Joe just said, contracts, but I think on top of that, one of the things that we run into so often, especially with smaller companies that we look at, is tracking your information, having good data, having a billing system so you're able to generate, an aging report, payment history on the customers, being able to supply all of the contracts. And when these folks come in and we're looking at a business, we're doing our due diligence. And the easier you make it for someone to understand your business and see that you're a good business, because you can have a great business, but if you can't track your metrics and show somebody that it's a good business and show them, attrition coming down, growth going up, that your customers are happy, you're in a tough spot.
Right. Bill.
I'd say also that not all RMR is equal, that Berg and Fire recurring revenue typically has higher margins, and so it tends to get higher values. Service RMR, not so much, but still, if it's under contract, gets the kind of financing the specialty lenders in this sector will provide. Time and materials revenue, not under contract, doesn't have the value that service revenue under contract has. And so it's all about where the margins are within the RMR classes and to what extent they're under contract.
So let's follow up on that. When you talk about metrics, what are some of the important metrics that they should be following? Because sometimes people might not, you're talking about metrics, but what are you talking about that are most important?
So the things that you want to pay attention to are, what is your average RMR? What is the RMR composition, which is what Bill was just talking about? Is it made up of Fire and Berg? How much maintenance is there? And be able to break that out for a buyer and show them the different pieces of it. Looking at attrition and being able to look at it on a very simple basis. When a buyer comes in, they want to see how much of your RMR was canceled over the last year compared to the average RMR that you've had over the last year. So being able to have that data and provide it. So it's attrition, it's average RMR, it's tracking your growth, your margins, your free cash flow, understanding your free cash flow. And I'm not talking about steady state free cash flow. I'm talking about your free cash flow of running your business. At the end of every month, how much cash do you have available to fuel your growth and or replace your attrition?
Can you explain the difference between the two?
Sure. Steady state free cash flow is taking a look at your business as if you weren't growing anymore. So if we stopped today and you stripped out all your sales efforts and your marketing efforts and you just were going to run your business, which is a very important metric, particularly for lenders, and taking a look at, can you pay back your debt? Can you finance, all of your capital that you have in place? But you also want to look at, if you weren't going to stop growing your business, and if you're going to continue growing your business, you want to be able to look at how much cash that generates. And so you want to look at your margins, but then what comes into play is your cost of capital, your amortization, your cost of equipment. And so how much cash do you have at the end of the day, every month, that you can then reinvest into your business?
Thank you. Bill, any comments on that?
And certainly the attrition rates. You want to be able to identify what your attrition rate is on a historical basis. And the way lenders look at attrition is by taking what's called a static pool approach. And that's by saying, you look and see how many accounts were performing on January 1st, and how many of those same accounts are applying or are paying on December 31st, and averaging those numbers over a 6 to 12-month period to see how your base account base is performing over time. That is probably the single most, that's the canary in the coal mine. That tells you how you're doing with your customer base over time.
So you're saying attrition obviously is important. I know everybody knows attrition is very important. And I know there's been a lot of studies on attrition in the industry, but can you guys give some, what is a typical acceptable attrition rate in maybe residential, maybe commercial, that you can give some sense for the audience that's acceptable from a lender's point of view and from an alarm company's point of view?
Well, again, all RMR is not the same. So an attrition rate for a burglar alarm base is going to be different than the attrition rate for an access control base or a video base. And you want to stay within the norms of those classes. So if you see a burglar alarm base at 15%, you're going to spook just about every lender on the planet who knows what they're doing. If you see but if you have an 8% base of that rate within the Berg class, you're going to make people comfortable. If you see 8 to 10% of access control, that's going to scare you. It depends on the class you're talking about.
Joe, can you give some perspective on, from your company's point of view, what's acceptable and not acceptable from attrition point of view?
I mean, a little bit to Bill's point, it really depends on the base that you have and what types of services you have. But if you're a full service company that has all of those recurring services, I mean, the way that we look at it is, if you're in the 12% and under range as a blend, we think that makes sense. We think it's pretty industry average. And then we take it one step further and really kind of look at, how long have you had the customers? I mean, what kind of relationships do you have with them? But I think from a basic attrition standpoint, I mean, I've been doing this for a long time. I go and look at companies and they tell me they have 3% attrition, and 60% of, 40 to 50 to 60% of attrition is, people moving. And I say, it's impossible. I mean, it's physically impossible. So we kind of look at what realistically is. And I can tell you this, every company that we look at, whatever they say their attrition rate is, it's always higher. We know it's always higher. And that's okay. It's okay. You kind of handicap for it and you think about it. But when somebody says their attrition is 6%, it's not. It's maybe 7%. It's close. But it just depends on how you look at it. But I think overall, to me, as a blended base, 12% to attrition on a gross level is, I think, acceptable.
Okay, and one more follow-up on attrition. I like to ask Mel, there is so much talk today about the interactive services that are hitting the market, and it's becoming stickier for customers to stay with you. Can you give some sense of what that means to you and your company? And Bill, I think you were at the mobile app session, and he was very impressed with that mobile app session. And I think he learned something there also. So let's start with Mel first.
Yeah, I mean, we do hosted video, and we do managed access and things like that, and we've been doing that for several years. And the cancel rate on some of those, in the hundreds of accounts, is 0. Okay?
He doesn't believe you, though. But go ahead.
Well, he's on my board, so he knows the numbers. Okay? And I get involved in a lot of the acquisitions, and I take my iPad with me, and of course I've got my home on, you know, Total Connect and video and everything else, and you're sitting with someone that's getting $18 in recurring, right? And I say, well, our residential's coming in at 38. How can that be? And you say, well, first of all, service contract. 80% of what we install is on GSM radio. And now we're adding Total Connect, okay? That's how you get there. Wow. And think how much more your company is going to be worth if you're getting 38 rather than 18.
Right.
Yeah, that was a very cool session yesterday on mobile apps and the security industry. It was eye-popping in a lot of respects. One thing that we do know, though, is that while enhanced services, cell phone-based remote services are protecting the revenue streams to some degree, it's not the only variable. Very high-priced RMR, where you've bolted on enhanced services, is still vulnerable because there are folks out there very happy to take that rate over at a lower price. So you've got to think about the variety of things that go into this. And this is one of the things that you know, one of the most fascinating aspects of this industry over the recent years has been the arrival of the summer program models. But all that rate is priced at very high, you know, relative to the average rate in the industry. And a lot of those contracts are still in their first terms. So you know, we're watching very closely how that rate's going to perform, because when it reaches term, you know, folks like Joe and Mel, who are operating traditional models, you know, have to be licking their chops, because that's going to all come due, and they're going to be able to take that stuff over at a much lower cost. Not speaking for those guys, but I'm speaking for those guys like those guys. So let's watch all this and see where it's going, because Alarm.com and Total Connect and products like that are very, very helpful to retaining RMR. But when you're at 50 or 60 bucks an account, you might be asking for trouble.
Amy.
Yeah, a couple of thoughts on that. I mean, I think exactly that. When the contract's up, people are going to be looking at it as a possible takeover. So I think if you're running a business and you have these added services with your customers, one of the key things is to pay attention to usage. What we found is that the number one cancel reason for an account that was mass marketed with additional services is, I don't use it. It was really cool when I got it. It's like that treadmill that you buy and it sits in the basement now with, you know, boxes sitting on it. They don't use it. And when it comes up time, they say 50, 60 bucks a month, is that really worth it? So paying attention to usage rates and whether or not the customers are using it and following up with them, I think, is one of the critical parts of paying attention to that. I wanted to just circle back on attrition.
Yes,
one
please.
minute. Just one thought I had on it. In addition to looking at the attrition, so often I've gone into companies like Joe has and seen, they said, oh, 5% attrition. One of the key things to also pay attention to is, you know, looking at your attrition reasons and tracking those very carefully. And one of the metrics that we have is that we're able to provide, you know, exactly why each of those customers canceled. You know, a primary reason and a secondary reason. You know, they're canceling because of end of term, but what's the real reason why they're canceling? Or they're canceling because they're moving. Well, why are they moving? Are they going into an old age home, or are they going somewhere else that you can install a system there? And then also looking at your aging. We have found so many companies that have shown us 6%, 8% attrition, and then we go in and we look at their rate at risk. So all the AR that's over 90 days past due, if you were to write it all off today, how much RMR are you going to lose? And we factor that into our attrition calculation in due diligence, because your attrition may look great, but chances are your rate at risk is probably pretty high. So managing those two is very important.
Thank you. Obviously, attrition is very important, as you can see, from everybody's perspective. So I'm going to shift just a little bit, and I'm going to ask this. I'm going to throw this question out there. How often do you see EBITDA as well as RMR when placing a value on a potential acquisition? Joe, how do you look at that, or do you look at that?
We always look at it.
Okay.
I mean, but it depends on what we're looking at. I mean, we buy integration companies, so we naturally look at EBITDA, and we sometimes do blocks of accounts, which, you know, EBITDA naturally should come to you. So, but you can't really look at it that way. So we look at them both, and then we balance it and see how does it fit? Does it work? More importantly, how does it fit into what we do? How does it drop to our bottom line, and how do we make sense of it in kind of things the way we look at it? But we still look at it both ways.
What doesn't work for you?
Well, what doesn't work for us is that it's like anything. On a multiple of RMR, buying a company, you talking about buying a company?
Yes.
Buying a company on a multiple of RMR, I mean, you can't pay more than makes any sense to you, or, you know, you end up bankrupt and they end up rich. I mean, so you got to be really cautious about what you look at. Like my good friend Bill here says, if you want it bad enough, you're going to get it bad enough, you know?
Be careful what you wish for, right?
That's right.
Yeah, okay, gotcha.
Yeah.
Mel, from your perspective.
Well, if you're looking at a new location where you got to justify office and staff, EBITDA is very, very important in that case. So you're looking at both RMR and EBITDA. But if you're looking at fold-ins, which is what we do mostly, okay, they're going to come into one of our existing offices. All the infrastructure that's in that other company goes away, so EBITDA will absolutely go up. And if you look at where we got our best technicians and salespeople from, that's where they came from. You know, we'd like to say we hire them and train them and do good work, and we do pretty good at that. But if I take the list of our 82 salespeople and look at the top 30, most of those people came from those acquisitions.
Okay. Bill, you have any thoughts on that?
I just say that RMR, when Joe and Amy and Mel talk to a dealer about buying their RMR, they're really not thinking in terms of RMR. RMR is serving as a proxy for pro forma EBITDA when you combine what they have with what they're buying. And so really it's a conversation that happens, that it allows Joe and Amy and Mel to talk to much smaller folks whose EBITDA numbers are irrelevant to them. So it's really a means to set a common communication in the industry. And from my perspective, I look at it to make sure that it can service on a pro forma basis, meaning a go-forward basis, the interest expense of the debt they're using to buy that rate. So really, RMR is essentially another way of talking about EBITDA to the buyers of that RMR.
Thank you. I'm going to shift to another question. Amy, I don't know if this makes sense, but we'll try this here. RMR, okay, there are so many different RMR services coming into the market. How are they actually valuing RMR today, whether it's interactive services, remote monitoring or remote video monitoring, managed access, Bird, things like that? Could you give us a sense of that? And we'll ask the panel, too.
I think that, when I got up and spoke a minute ago, one of the first things I said is that, this industry changes very slow. It's like a big ship turning, and these things are catching on. I think we've all seen more changes in the last 2 years, 3 years, than we have in the last 25 years.
Yes.
So now with that is figuring out how to value them. And I think I've seen so many different views on that. Whether it's, looking at the pass-through rate of the cellular cost and whether that should be valued the same. I think everyone's still trying to figure it out, really. And yes, it's having some negative impact on margins because you're bringing in the higher RMR, but some of that higher RMR has some incremental costs that you really need to understand, whether it be the cost of alarm.com or, any of the video services and everything. So it is having some negative impact on margins. But going back to the other thing I said is free cash flow. You have a bigger pile of cash at the end of the day. So it's weighing, your free cash flow versus a little bit of an impact on margins and how do you value that business. So I've seen it all over the map right now.
Right. Who else wants to take a stab at that one?
There's a company here in Nashville that's at $9.95 monitoring. Really? And they just made the SDM 100 list at number 99. And I know who does their monitoring for them, and I know what the price is. So they're paying $1.60 from this third-party monitoring company per account. They're almost all residential. But the owner, his son now runs the company. We were flying back from IFC. Southwest flies direct to Las Vegas from here. And he said, Mel, would you consider monitoring for me? And he's buying me a drink, and then I said, you haven't bought me enough drinks yet, But that company, and he'll tell you that there's 2 price-sensitive markets in the Nashville area. Murfreesboro, Tennessee is one. Clarksville, Tennessee is the other. And he said that's where 80% of his accounts are. Because, you know, they're Berg only, sitting on landline phones, and he walks in at $9.95. Yeah, I mean, they have no value in that system. And Bill really specified earlier how you break that out. And, you know, the more you move up in managed services, the higher the value.
So Bill, help us out with that. Give us a little bit more definition of what it means. How do you value video monitoring, remote video monitoring versus Berg?
Well, as I said earlier, margins are important. Video monitoring margins aren't as high you know, when you add a new video monitoring account, the margin on that account is not as high as if you add a new burglar alarm account. So that's one variable. The other thing I care about is whether Amy and Mel and Joe will buy it, or other strategics will buy it, because I'm looking at that as my collateral. And so if collectively these folks put a value of 20 times on video RMR, then I know I'm safe going in at 15 times. If they get more aggressive and they do it over time on a consistent basis, then the advance rates for that stuff will go up. And if those models blow up, then the advance rates will go down. So again, as I said, the bankers of this world are not wanting to be the pioneers with the arrows in their backs. They want to be the folks that know that the operators are putting enough sustained value on this rate that they'll buy it on a consistent basis over time.
So do any of you see any risk as technology gets better and better that, you know, right now everything's new, people are willing to pay because it's kind of new. Do you see any risk in the future where RMR values start going down because there's better methods being developed, more apps flooding the market, more demand for it? Which, yes, go ahead.
Well, the risks are going to be if the values go down, and that'll have a lot to do with other things besides just the rate itself. For example, you know, what is going to be the long-term impact of the cable companies moving into this business? They've got a whole different set of priorities and objectives, and they could bring the price down because they're going in at a consistent basis at $18 a month for the add-on for the burglar alarm. We don't know yet, so we're watching it carefully, and you know, don't have the answer yet ourselves.
Joe, do you have any comment on that?
I don't know, I look at things a little differently.
Yeah, okay.
I mean, you know, when you look at reoccurring services, I mean, the landscape's always changing, right? I mean, but even though it's changing, it's still the same. You know, principally, if you think about the old days where, you know, you charge somebody, you know, $1 a day for monitoring and, you know, most of it dropped to the bottom line, those are all great margins and everything's good, but the reality of it is monitoring's a commodity. I mean, somebody could charge $10 tomorrow if they wanted to, and they do. But I think what you really look at is what is the value to the customer and the usage. So when you talk about other services like video and all those kinds of things, and do they have different values? Well, the reality of it is on the commercial side, you know, insurance companies are still dictating. I mean, fire systems, jurisdictions are still dictating. They need to have those services, and the better that they can have services that help their business, whether it be recouping loss or whatever the case may be, the stickier they're always going to become. And it's still, again, if you're pricing it right and you're providing services, nobody really likes to change. Change is a hard thing for a lot of people. You know, it's like back to this phenomena, I don't mean to digress here, but we talked about this phenomena of after 3 years when the contract expires, you know, you get this big drop-off. It's really counterintuitive, right? But why do they do that? Do they do that because they were browbeat and you talked somebody into buying something that they didn't want? I mean, why do they do that? They do that because, as Amy said, it's no longer exciting to them. They don't find the value. They're paying too much money. If you price it right, people don't think that way. The other way is that, you know, you always have somebody coming in, but nobody really likes to change. So it's really important, as a seller, that you really just take care of the customers and you price it right. In Bill's example, when they came out and, you know, you're adding all these services and you're at, pick a number, $69 a month, I think those are always, as you come into your cycle, they're always going to be at risk because somebody's going to come and do those services cheaper. But if you're priced right and you're providing services and you're within 10 to 15%, just think about your own lives and everything that you do. What gets you to change? You know, what gets you to change is sheer aggravation, or you feel like somebody's overcharging you for something and you're not getting the value. So this cycle of how these, at end of contract expiration, that they go away, I don't think we're doing enough we're not doing a good enough job in the industry to promote the value. Now, I think today, things are a little different. I think with these enhanced services today, specifically talking about residential right now, the enhanced services today, they really do add a lot of value. The customer's touching it, using it, everything, everybody's part of it. It's a lifestyle process. It's not just a, you know, if the alarm goes off, hopefully somebody answers it. I mean, I hate to say it that way, but I mean, that's the reality. So those are going to be sticky. Now, if you start to see those change as the contract expires, then I don't think you're going to see a change because they don't see the value anymore. You're going to see a change because somebody's coming in there and saying, I could do it for cheaper, or I could provide better services. And although we haven't seen that test of time in that analysis, that's what I think is going to start to happen. I think the base is going to get more solid and more solid as we continue to add these enhanced services at the right margins, pricing.
Mel?
Yeah, just a comment on the cable side. You know, with the cable companies and the telcos coming into the market, they've done that before. And if anybody believes they're going to be the same this time and, you know, not be successful, I think they're wrong. I think they got a different approach. I think they're smarter about how they do it. I think with the cable companies in particular, I think where their vulnerability is going to be, you know, first of all, we have a policy we don't sell to renters. Well, they sell to anybody, right? Mm-hmm. So there's a cancellation vulnerability they're going to have. The other thing is if they bundle it in with their cable services, people switch cable companies all the time. What are they going to do with the security piece? That'll be a tough thing as well. So that's, you know, we're not going to underestimate what they're going to be, but they've got a couple of Achilles heels in there.
Well, let's open that up right now, because you started bringing up cable and telecoms and whatnot. Amy, do you have any thoughts, and Bill, on is it Groundhog Day, or is it going to be something different this time?
Yeah, I think on the cable side, I would add to what Mel just said. The third hurdle I think they're going to have is service. And I think at the end of the day, taking care of your customers, letting them know you're there, and that you can provide service within a short time frame, that you can solve their problems for them, that your installs, you go and you install it and it works the next day. I do know that one of the problems that the cable companies are running into is that, you know, their installers right now are cable guys. And so folks are having to come back over and over to get it installed right. And then just the old adage that, you know, you don't want to rely on your cable company for service. And so the security industry is really focused on service, and these customers, they're protecting their home and their family and their children. I think sometimes people forget about what we're providing here. And when that alarm didn't work last night and their daughter was scared, they want to know that someone's going to be there the next day, that they know what they're talking about. So I think that's one area where the security industry, the traditional security industry, can really focus on to give them a leg up to the cable industry.
Bill?
Yeah, I mean, historically, they got into the business in the late 90s through their unregulated subsidiaries, the power companies and the phone companies. They were looking for ways to increase net income. And these businesses weren't core to their mission. They were side businesses that they didn't understand. They are big lumbering companies with non-service-based cultures, and they charged in not really fully understanding what they're doing. I think today, as a friend of mine who I respect a great deal says, who is working closely with them, is saying that, in his view, it's like the opera singer just clearing her throat. They've just begun to, they're putting on thousands of accounts a week, and that's only going to get bigger. These are folks that, and when you add up Comcast, Cox, Broadview, Time Warner, they control over 40, they've got relationships with over 40 million households, and they can leverage the triple play into a quadruple play. They do have licensing issues, they do have service issues, but they've got technologies that they didn't have 10 years ago, and they can outsource monitoring. Today, that's what they're doing. They're not trying to build their own central stations. They do have kind of the last mile to the consumer. You know, it does make, in my view, particularly the high value per dollar RMR models vulnerable. I think an interesting thing to see is whether, I mean, these businesses still are driven by the billion-dollar good idea, and it's hard to grow organically to $1 billion of scale quickly. So one of the things we ought to watch is whether any of these companies get impatient, and they're the ones that buy ADT or some of these other players or these three folks to see if they can jumpstart what they're doing. But I think they're real. I think they're going to provide a threat that they didn't provide before.
Great. There's all these private equity people coming in now. There's such a huge interest by private equity folks. What's driving them? Why such a huge interest now? And when you are talking to somebody in private equity, what's the language that you need to use with them too? Or Joe, you want to take that?
Yeah, I mean, I think the reason that private equity is so interested is that what you find is that throughout the years, this industry has proven pretty resilient. And over the last 3 years, it's proved very resilient. It's not recession-proof, but it's very resilient. So if you take a private equity group and they have, let's say, 6 or 8 or 9 portfolio companies within their fund, the one thing that they want to feel comfortable about is they have one that's really a nice, steady performer and is not really going like this. And I think that that's really, really important to them. I think they can get a really good return. It's fairly safe in their eyes based on what they've seen. And it's very, very attractive. And today, private equity, has a lot of pent-up funds. There's a lot of dollars out there because not being able to put them to use. So I think the security industry has been a perfect place for them to do that. And maybe it's not a top performer, but it's not a low performer. It's a nice performer right in the middle that gives them good stability.
Amy, how about you?
I think it's a safe industry, and it's proven that over time. The returns are there, the margins are high, cash flow is there. And then you add on top of it, which I think one of the things that's driving, two things I think is driving the private equity interest right now. One is surviving a recession and seeing an industry that actually can even thrive at times during a recession. And then secondly, all of the new technology and the new services. It's showing an industry that survives and is now on the cutting edge and has a lot of growth opportunity that wasn't there a couple years ago.
Right. So I'm going to turn up a little bit of a notch. Bill, they're saying some great things, safe and whatnot, but what keeps you up at night when you're dealing with this industry and private equity? What are your fears?
Well, private equity relies very heavily on the debt capital markets to make their returns. So when you sit down with a private equity investor who's looking at an alarm company or security monitoring company, they're typically going to want lots of leverage. So that's where the rub is. And the debt capital markets are very supportive. I would add the other reason why the private equity markets like this industry is because the debt capital markets are very supportive of it. They can get a lot of leverage. It's typically interest only on the senior debt side, and so it's very friendly financing. The tension is around how much leverage and how aggressively they want to have it structured. So that's where the deals fall apart. When you have a financial sponsor behind the deal, you typically have very sophisticated management and boards who are watching these things very closely. But to step back, if you look at the typical institutional money manager, pension funds, insurance companies, endowment funds, about 10 to 20% of their capital is invested in what are called alternative assets, and these include hedge funds and private equity funds and real estate funds. And those dollars translate into billions of dollars under management, which they're under pressure to put to use. They've got to use it or lose it kind of requirement at the private equity firm. So they're going to be aggressive, and they're going to try to put it to work in ways that enhance their yields to satisfy all these institutional investors who, if they don't get their yields, won't place any more money with them. So, you know, you just got to be very careful. And not all, just like all RMRs, not all private equity firms aren't equal. And some of them know what they're doing, and some of them don't. And some of them think they're the smartest guys in the room and won't listen to anybody else and make mistakes that have been made many times in the past. So, you know, you have to really evaluate who you're doing business with, like any other relationship. That's what scares me about private equity firms.
Awesome. I know we didn't take any questions from the audience. One is because I can't see you. And number two is it's time for us to end this. But I'd like to say thank you to these folks up here on the stage for doing a wonderful job. And I hope that we answered the majority of your questions. But if you have any other questions afterwards, please come up and see them, give them a business card. They'd be glad to talk to you. Let's give them a warm applause for this. Thank you. Thank you. Great job.